So today we are going to discuss our unit 5 and 6. These are financial risk management, that is unit 5, and forecasting analysis is 6. Broadly, we have to discuss these things: risk and return, quantifying investment risk, diversification, beta and asset valuation, derivatives, correlation and regression, learning curve analysis, time series analysis, expected value and sensitivity analysis. These are the broader topics of the day. Before I go in the detailed discussion, I have to tell you what we are going to discuss in general. We will start our discussion from risk, and it is related to the return. Every investment, either you are an individual investor or you are a corporate investor, you have risk and you have expected return of it, and which is different. For example, if you make a restaurant, the profit is different. If you make a hotel, if you make a hostel, if you make you can say a shopping plaza, if you make a hospital, if you make a school, the income and expense structure for every organization is different. So if you have a lot of money, you have different options to invest. So what you are doing is, rather to invest all money in one business and lost all money once together, the concept is now arises that you take different sort of risk. This is called splitting the risk, and because every risk has its own returns, so if one business is giving loss, the other business will giving you a profit. This is the concept of portfolio management, on which the all banking industry or financial analysts for the groups, they are working on that concept. That they see, we have a trading company, we have a manufacturing company, we have a real estate, we have a bank, we have a finance house, we have the hotels, we have the resorts. So every owner is the same. So being an analyst, we also all is protecting his money. And we are giving them options that this is the best investment, it has expected risk, expected return. Risk is the expected loss. More expectation of the loss, the more your money is at stake. In financial management, we have a basic principle that higher the risk, higher the returns. Because once you take more risk, you expect more money. For example, one way is to earn is you get up in the morning, you go to the office, after 30 days you will get little salary, maybe 20,000, 30,000, 40,000, depends. And the easiest way, but most risky way, is you go in some other home and you cash them and snag their money. Maybe you, in one day you will get 100,000. Rest 29 days you can sleep. So it's an option. Options are with you, right? I'm just explaining you risk and return in a simple way, so it should be in your mind. So what you did is, you took a big risk. You took a risk of being in prison. If you caught red-handed in the home, your career was finished. You took a big risk, you get a big return. Those who take small risks, they go to the office every day after 30 days because they have work, they have a secured risk, they have a secured income. This is how we have to see. Now, if you feel stock market is going very bad, no one is going to the stock market because it's not going good, you go to the stocks, invest. What you did, you took more risk, and maybe you come up with more returns. It may be positive returns, it may be negative. Higher the risk, higher the return. So this is the concept of risk and return. Being an CPA, we have to invest we have to advise our board of directors where they should invest. But before that, we should know that what is the risk and what are the returns associated with any investment. Then we will quantify investment risk. Then we have to discuss what are the types of the risk. We have so many risks. Risk of losing the job, risk of getting accident, risk of default risk there, our heart stop working. This is another sort of risk which is associated with us. Our car can be stolen. This is a risk. Environmental risks are there. Oxygen, cyclone, rain will damage us. This is another risk. So in case of so many risks, business also has the risk. The biggest risk with the business is the business itself can lose. That is a business risk. The nature of the business that you started, it was a software house. That software no more. New software technology has come. So the duplicate risk is there. Then your employees may involve in fraudulent activities, employee risk. All transactions are not posted, transaction risk. Auditor did not perform good audit risk. Right? Management is not focusing on the core area, managerial risk. So, lot of risks are involved within the company. Our work is to identify a risk, then prioritize the risk based on the fatality and the volatileness. We have to prioritize, and then we have to apply techniques to mitigate the loss. Mitigate the risk means how to avoid the risk or eliminate the risk. Elimination of the risk is not possible. Minimizing and reducing is required. Diversification in the environment when you are going to spend everything in real estate. And real estate suddenly there is no demand. So you lost your money in one business. That is no more an approach. Now the approach is to go for a diversification. If you are selling milk, you can sell the mobile, you can open a trading shop, you can make a retail business. This is how you diversify, and the purpose is the same, to spread your risk over different businesses, and because every business has its own expected return. So if this business is in loss, this business is normal, this business is good, so you can, on total cumulative effect is positive. Beta is the term, is a statistic term which is used to calculate the variations of the stock movements. Alright, this we are discussing today. Asset valuation, what is asset? Asset is a valuable, your car, your equipment, your plant, your home, your buildings, these are assets, our value. Derivatives are the form of financial instruments. Correlation and regression are statistical techniques. This is in basic school maths we studied that there is a variable x, there is a variable y. And if they move together, they are correlated. If they don't move together, these are not correlated. Correlation generally is equal to 1. It is positively correlated while we study. If the government gives more incentive to the manufacturer, so more production will take place. There is a correlation between government policies and manufacturing. That's what we discuss. If you see the economy in whole, as an analyst, you should know what policy is going to bring the change in the business phenomenon. And within the companies also, if you are going to have more sales staff, does it relate with more sales figures? If you have more customer services agents, are the customers satisfied? If yes, then it is positively correlated. Otherwise, this is negatively correlated, or there is little combination. Suppose if a student says, I will study whole night and I will pass. If he studied whole night, he passed. So studying whole night and pass are correlated. If a student says, I don't study, I pass. So then not studying and passing is correlated. Because if you don't study, you pass, so both are correlated. But it is in fact opposite. If you don't study, you don't pass.